All right, dear students, we are now going to do advanced financial reporting past paper, and this is March 2023, which you can find on the website. So we are doing the standard wise practice. So we'll skip the question number 1, which is consolidation, and we'll go to the section B, in which you have 4 questions. So you need to attempt any 3 questions from these 4 questions. So we have the question number 2, and let me just zoom it. Yes, now it's okay. So we now move to the requirement. And it says explain to your assistant. So that means you are a supervisor or you are someone senior. How the above technical issues, so above technical issues means which are given in the question, must be accounted for in the financial statements for ZICA Manobe for the year ended 30th September 2022. So you see, obviously you need to recommend the accounting treatment to your assistant regarding the above technical issues and how they should be recorded within the financial statements for the year ended 30th September 2022. Now remember one thing, that whenever you are doing such scenarios which are related to the standards, make sure when you're reading the case, make sure when you're reading the case study, and you find the appropriate term, link it to the standard, and bring the accounting treatment in your mind, the complete accounting treatment. So whenever you read the case study, so we have the case study, you read it, and once you read it, you identify and highlight the key terms within the case study, regarding which obviously we need to recommend the accounting treatment. So key terms within the case study, and then bring accounting treatment to your mind, the complete accounting treatment as per the standard. And let me just show you how it works. So whenever you're reading the case study, make sure you read it properly. Make sure you are attentive, make sure you are focused. And when you read it, you identify the key terms, identify the key stuff, key things within that case study, and bring accounting treatment to your mind. And that is what we need to write in that particular part. So you are the financial controller. Your assistant is preparing the first draft of the financial statement. He has a reasonable general accounting knowledge, but is not familiar with the detailed requirements of all relevant international financial reporting standards. So you are the one to guide them. There are 4 technical issues on which he has written you separate emails seeking your advice. So this is the part number A. And remember what I said, that you need to read the case study, being focused, being attentive, and then identify the key terms in it, key stuff in it, and then bring the accounting treatment to your mind. On 1st October 2021, we lent K2 million to a customer in order to assist them with their expansion plans. We lent. So we have given the loans. Now we know that loan is a financial instrument. And when we are giving the loans, that is financial asset for us. And to whom we are giving the loan is the financial liability for them. So remember that we lent over here. So this is something very important, because maybe if you're not reading the case study properly, and you read the term the loan, and you read the term interest, maybe you treat that thing as a financial liability. But we lent K2 million to a customer, so that means this is the financial asset. So you have already identified the term, and now it becomes easier for you that, okay, we lent K2 million, we have given the loans, so this is a financial asset. And because this is a financial asset, this should be treated as per IFRS 9, which is the financial instruments. And we know that when you talk about the financial asset and you talk about the loans, this is the investment in debt instruments. So if you have already taken the lecture of IFRS 9, you already know that this is investment in debt instruments. So this is investment in debt instruments. And there were three treatments of the investment in debt instruments. And the third one is relevant, that if you're giving the loan, obviously the intention is to keep that financial asset till maturity, and that is only the principal and interest, and there is none other than the principal and interest. That means the cash flow characteristic test and the business model test. So there were two tests, the cash flow characteristic test and the business model test. So cash flow characteristic test and the business model test. You will keep the loan till maturity and this financial asset till maturity, and this is merely the principal amount and the interest. So the loan costs K 100,000 to arrange. So I guess we need to charge K 100,000 as a cost in the current year. We agreed not to charge interest on this loan to help our customers short-term cash flow, but expected the customer to repay K 2.4 million. So we gave the loan of the 2 million and there is an associated cost with it. Okay, that is fine. That becomes a part of this. And we have no payments involved within this arrangement, within this agreement. No payments. We know that the working of the financial asset is we take the opening balance, which is the initial value. We add the interest on the effective rate. We add the interest on the effective rate. So that is interest on effective rate. And the payment is done on the nominal rate. Now, in this question, there are no payments because it says we agreed not to charge interest on this loan to help our customers short-term cash flow that they don't need to make any payments during the year, but expected to repay K 2.4 million on 30th September 2023, right? So there's no interest involved in it, no payments involved in it. This will mean we can't take any profit this year, but there will be a nice bonus next year when we receive the repayments. I was told by the finance department that the effective annual interest rate is 6.9%, based on which we calculate the investment income, because this is the financial asset working. The closing balance represents the financial asset, and the interest payment, this interest payment represents your investment income in the statement of the profit or loss. I don't understand the relevance of this information as no interest is payable. So this was a very easy question right from the start. We lent, so it became clear that this is a financial asset as per IFRS 9. And you know that this is a loan and the interest, there is nothing other than that. So this is amortized cost treatment. So you will write, we have given the loan of the K 2 million to a customer. This represents a financial asset as per IFRS 9 financial instruments. The loans, which is the financial asset, should be treated as at amortized cost. It will keep the financial asset till maturity, and there are only principal and interest involved within this arrangement. So first of all, we identified that this is the amortized cost treatment. And we wrote these lines as I said. Then you need to show the working that the following figure should be recorded within the financial statements. You take the opening balance. This opening balance is actually the initial value plus the cost of the loan. So we capitalize it, and then we add the interest on the effective rate, right? Which becomes your investment income in the statement of the profit or loss. In the payments, we need to show 0 because there are no payments involved within a year. And that closing balance represents your financial asset, which will be the opening balance of the next year. So this is what you need to write for these good 5 marks. A very, very easy part, as long as you identify the relevant thing within the case study. So again, we'll keep the same stuff throughout the question, that whenever you're reading the case study, you remain focused, you read it, you identify the key terms and the key stuff within the question, because that key term and the key stuff shows the accounting treatment which we are supposed to write in the drafted answers. Again, the next part is for the 5 marks. On 1st October 2020, we bought a large machine for K 20 million. This machine has an estimated useful life of the 8 years. So that means we need to depreciate it over the 8 years, but we'll need a substantial overhaul. So now you see that we bought a machine. Now we know that for business use, this is the property, plant, and equipment. Now the property, plant, and equipment needs to be recognized initially at cost, and subsequently it is being depreciated over the useful life. So everything is crystal clear within the question. You bought a property, plant, and equipment, and the life is 8 years, and you need to depreciate on that. And then it says overhauling. Now you have already taken my lectures, and I have explained each and everything over there. The treatment of the overhauling is that we capitalize it, we capitalize the cost of the overhauling, and we depreciate it until the next overhaul. That simply means that we divide it, we depreciate it over the overhauling period. So we need to see whether it is same the 8 years or different. But we will need the substantial overhaul. So you write the accounting treatment as per IAS 16 that the overhauling cost is capitalized and is being depreciated until the next overhaul. That simply means divide by the overhauling period. In order to enable it to be used for the final 4 years of its estimated life. So that means the overhauling cost would be depreciated over the overhauling period, which is the 4 years. This overhaul cost is likely to cost K 4 million based on the prices prevailing at 1st October 2020. Now, we know that the cost is K 20 million, and out of that K 20 million, 4 million is the overhauling cost. Now we need to separate it. We need to separate it. Why we need to separate it? Because obviously this K 4 million needs to be depreciated over the 4-year period. And the rest of the machine will be depreciated over the 8-year period because overhauling is capitalized and depreciated over the overhauling period. If the overhaul occurs, the machine is expected to have a reasonable resale value at the end of its useful life. Okay, that's the scrap value, which is our accounting estimate. On 1st October 2028, so again, the resale value is the scrap value, right? So you just need to identify the relevant terms. On 1st October 2020, the estimated residual value of the machine was K1 million. Okay. On 30th September 2021, this estimate was divided to K1.1 million. And on 30th September 2022, the estimate was revised to K1.2 million. Now we're just going back to the question. Our year end is 30th September 2022. So by the year end, the estimated value, scrap value is 1.2 million. Now we know when you talk about the scrap value, this scrap value is accounting estimate. And as per IAS 16, IAS 16 states that the accounting estimates, which includes the scrap values, which includes the useful lives, and which includes the depreciation methods, needs to be reviewed at each year end. And if there is a genuine change, you can revise it. An accounting estimate is always changed or revised prospectively. So it is always revised prospectively. So this is very important. So scrap value are the accounting estimates, and whenever there is a genuine change, IAS 16 allows that accounting estimates to be reviewed. Now you need to write these lines. So first of all, we'll write down the company has purchased the machine. This represents the property, plant, and equipment. It should be initially recorded at cost. There is an overhauling cost of the 4 million. Overhauling cost as per IAS 16 should be capitalized and being depreciated until the next overhaul. So the overhauling cost of K 4 million should be depreciated over the 4 years. So that means it would be K 1 million for every month, every year, sorry. And then you talked about the other K 20 million, in which first of all you need to subtract this 4 million because this is an overhauling cost, and then you deduct this the scrap value from it and divide it by over the 8 years to calculate the depreciation per year for the machine. And then you'd say that the scrap value represents the accounting estimates. And IAS 16 says that accounting estimates should be reviewed each year, and if there is a genuine change, it can be revised, and the revision is done prospectively. For some reason, we didn't charge depreciation on this asset, so this represents an error because the depreciation should be charged. And whenever there is an error, as per IAS 8, it should be done retrospectively. So that means the adjustment should be done in the opening balances of the retained earnings. I think this was a mistake, so I suppose I should charge the depreciation. So you need to comment on all these matters. So see 5 marks, we talk about the initial measurement of the asset. We talk about the overhauling cost, number 2. We talk about the depreciation of the overhauling. We talk about the depreciation of the remaining asset, which is K20 minus 4 and minus the scrap value. We talk about the scrap value and the change in accounting estimate, which is done prospectively. And last but not least, we'll talk about the IAS 8 errors, which should be done retrospective. So you see, whenever you're doing a standard-wise question, you need to have all the accounting in your mind. And this is, pretty easier question. So those who attempted in March 2023 must be, lucky to have this question. Again, another part is for 5 marks. During the year ended 30 September 2022, we provided consultancy services to a customer regarding installation of a new production system. This system has caused the customer considerable problem. So the customer has taken legal action against us. So I told you that you need to talk about the key terms. For the loss of the profit that has arisen as a result of the problems within the system. So they are claiming the damages. Now we know that when they are claiming the damages, our legal department considered there is a 25% chance the claim will be successfully defended, but a 75% chance that it will be required to pay damages of K 1.6 billion. Now we know that this is a case on us, and when the outflow is probable, now we need to see when the outflow is probable, the provision should be recorded, and when the outflow is possible, contingent liability should be disclosed. Now it says 75%, which means more than 50%, which is highly likely, so it is probable. So we will say that the outflow is probable, the provision should be recorded. Provision is a liability of uncertain timing and amount, and provision is an obligation, present obligation as a result of past event, and the criteria is that the reasonable estimate can be made, so which is 1.6 million. So it meets the criteria that there is a present obligation because there is an ongoing case on the company. Outflow is probable, so which is again meeting the criteria, and a reliable estimate can be made. So the criteria is complete. Now we need to record the provision within the financial statement. So you start writing that there is an ongoing case on the company, which means the company is required to pay the damages. The company believes that there is a 75% chances that the company will be paying the damages. So the outflow is probable as per IAS 37. The provision it should be recorded when there is a present obligation as a result of past event, which results in the outflow of the economic benefits, and the reliable estimate can be made. So the criteria is met. Accordingly, the entity needs to recognize the provision, and so the debit entry should be made in the profit and loss, and credit entry should be recorded in the statement of the financial position. So this is what you need to write as per IAS 37. We shouldn't suffer any overall loss because our legal people also tell me they are reasonably confident that we covered the insurance against this type of losses. So we know that even if the claim is insured, the assets cannot be netted off with the liability. The asset should be recorded separately if it is virtually certain that they will receive the claim. But if it is probable, they should record as a contingent asset and they could not record that thing as a receivable. But the outflow is confirmed, probable, it should be recorded as a provision. So we will make a claim as soon as the outcome of the case is confirmed. I assume nothing needs to be provided for here because we are covered, but I do not need any note disclosures. I assume nothing needs to be provided here for because we are covered. No, you cannot net off the asset and the liability over here. The contingent asset should be separately disclosed and the provision should be separately recorded. So again, if you know the standard and you identify the key terms, it becomes easier. So the last part that we are doing now, the last part, yes. On 1st July, and again, this is for 5 marks, case study looks a big, giant case study, but marks remains the same. On 1st July 2022, decided to sell one of its division as a going concern, following to recent change in its geographical focus. Now, if you have studied the standard, if you have read the standards, and you just remain focused while reading a case study, you will straight away identify that which standard it is. Decided to sell, not sold. They have decided to sell. So this is held for sale. Held for sale, and we know that is IFRS 5, non-current asset held for sale and discontinued operations. And discontinued operation is when you have a separate geographical element within it. The proposed sale would involve the buyer acquiring a non-monetary asset of the division, with ZICA Minerva collecting any outstanding trade receivables relating to the division and settling any current liabilities. On 1st July 2022, the carrying amounts of the relevant asset of the division were as follows. Now we know that when we classify an asset held for sale, we record that thing at lower of the carrying value and the fair value less cost to sell. Now, if you remember the standards, everything will become easier for you. So on 1st July 2022, the carrying amounts of the relevant asset were as follows. Purchased goodwill K 600,000, property, plant and equipment K 2 million, inventories K 1 million. That represents the carrying amounts of the asset held for sale. From 1st July 2022, ZICA Minerva began to actively market the division. And we know if we want to classify an asset as held for sale, this criteria should be met. So we start writing that if an asset is to be classified as held for sale, IFRS 5 states that it should meet the following criteria. Sale is highly probable, available for immediate sale, locating a buyer, an active program to locate a buyer, and expected to be sold within 12 months. So begin to actively market the asset. On 1st July, the directors estimated that they would receive K.3 million from the sale of the division. On 1st July 2022, the market condition have improved. On 31st October, ZICA Minerva received and accepted a firm offer to purchase the division for 3.3 million. The sale is expected to be completed on 31st December. K.3.3 million can be assumed to be a reasonable estimate of the value. During the period from 1st July 2020 to 30 September, inventories of the division costing were sold for this. At 30th September, the total cost of the inventory of the division was this. All these inventories have an estimated net realizable value in excess of their cost. I mean, confused on the applicable standard. So IFRS 5 SALE, and once the criteria is confirmed, you need to de-recognize the assets from the current assets. But you know, this is non-current asset held for sale and discontinued operations. So we are talking about the non-current assets because all the inventory is already recorded in the current asset at the lower of cost or NRV. So we are talking about the non-current asset held for sale and discontinued operations. So that means when you talk about the complete disposal group, so the complete disposal group, that is the cash generating unit. So we compare the cash generating unit complete carrying value with the cash generating complete fair value less cost to sell. We de-recognize it from the non-current asset when recorded in the current asset as held for sale at what value? At lower of its carrying value and fair value less cost to sell. And we do not charge depreciation once it is classified as held for sale. So this is what we need to write in the standard, and it was a very easy question.